Shocking new data reveals the trade of the decade. And in this video, I'm going to show you the data and the charts so you can understand what's happening, why it's happening, and why it's not what you think. Now, I'm going to show you how this whole thing is setting up to be the trade of the decade so you know how to be positioned to protect and grow your wealth as this market cycle continues. So stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss. I believe that the only security we have in life is for us to take responsibility for ourselves because the system's broken. No one is coming to save you, and this is why we must learn to make our money, grow our money, and protect our money on our own. Now, if you agree and you want to hear more about these topics and more people to hear about these topics, click the like button so everybody gets to hear, and then hit the subscribe button and the bell notification so you're notified every single time I put new videos out. Now, like I said, we're going to take a look at the trade of the decade. This is the big macroeconomic picture, okay? It's what's happening right now, and it's happening right before our very eyes. Now, these are some of the really big details they're easy to predict and see. It's easy to see the big trends, well, if you know what you're watching for, all right? So if you know what to watch for, if you know what to pay attention to, it's pretty easy to see exactly what's happening and what's setting up, and so that's what I want to break down for you today. Now, if you've been watching this channel, then a lot of this may not come as a surprise to you, but maybe the outcome is. Now, again, if you watch this channel, you know I talk a lot about fiat currencies. Fiat currencies, fake currencies, losing their value. As a matter of fact, I talk about all the time that the US dollar's lost about 95% of its purchasing power in the last 100 years. And other fiat currencies, they've done even worse than that. As a matter of fact, there's been about 152 fiat currencies that have failed due to hyperinflation. Now, of these failed fiat currencies, the average lifespan is about 24.6 years, just under 25 years. Of the median lifespan is about 7 years. 82 of these currencies lasted less than a decade, and about 15 of them lasted less than 1 year. So not a super good track record. Now, the British pound sterling, founded way back in 1694, is the oldest fiat currency in existence today, way past the 25-year lifespan. As a matter of fact, it's 317 years old. And so you would think, or I guess it should be considered the most successful fiat currency. Most of them last 25. It's gone 317. It's pretty successful, right? I guess it depends on what you consider success. And like I always say, all things are relative. So success is relative. So the British pound was originally defined as 12 ounces of silver. That's what it represented, 12 ounces of silver. Today, silver is about 20 British pounds per ounce. So that means it's worth about 0.5% of its original value. In other words, the most successful, if you call it that, longest standing fiat currency in existence has lost 99.5% of its value. Would have been much better off just holding the silver, right? Now, of course, this is not an accident. This is not a mistake. The very nature of fiat currency is to be inflationary. This means that over time, they continue to print more, which causes inflation, which causes the values of those fiat currencies, those dollars, to continue to lose value. Again, if you watch this channel, that shouldn't be shocking to you. But what is happening with all the fiat currencies might be. So we're going to talk about that. Now, like I said, most people, if they don't really understand this, they think that the prices of houses are going up, stocks are going up, gold's going up, Bitcoin's going up, etc. But really, you have to shift your mindset and shift the way that you look at it, because it's not that everything is going up in value. It's that the dollar's going down. And so what it means is that it takes more dollars to buy those same things. Now, again, it's supposed to do this. Now, the Federal Reserve, the Central Bank of the United States, we have about a 2% inflation target. That's what they want, 2% inflation. Now, they've been unable to get it, I guess, apparently looking at the CPI. That's a whole nother story. We're not going to dig into that. If you want to know more about inflation and CPI, leave me a comment. We can do another video about that. But the Fed, they want to get about a 2% inflation. They want to increase the money supply by 2%. They want to take 2% of your wealth away every single year at the same time. And they're doing this by injecting money, all right? They're injecting about $5 to $6 trillion into the economy just in the last couple months alone. And the Fed still can't see the inflation they want, even with all that. Now, just this week, Fed Chair Jerome Powell announced that they're going to be releasing the results of a year-long study And the market's already making its guesses as to what's going to happen. Markets have been betting on higher inflation. I think that's what most people expect. And we can see this pretty clearly when we look at the gold prices taking off, right? Gold just broke all new time highs. It's over $2,000, so forth. And the falling dollar, which is basically causing people to rush to inflation-proof assets. So while we're waiting for the official report from the Fed, we already pretty know what they're going to commit to, right? They're going to commit to low rates for years and years to come, right? They already said they're not even thinking about raising rates. So they're going to commit to low rates for years to come, 5 years or longer. I've done videos about that. And as they push their agenda for higher inflation and trying to get back to full employment, that's another one of their agendas, we're just going to see that the dollar is going to keep responding to this. In fact, the dollar has just had its worst month in a decade. In July, the reserve currency weakened the most I think it's ever had in a month. The dollar index, which measures the US dollar against 6 other major currencies, has dropped nearly 7% since May. It's lost about 4% in July, as you can see by the chart up on the screen. Now, this is the biggest monthly drop since September of 2010. The dollar started to strengthen on Monday, but then as the Federal Reserve continued its giant unprecedented monetary policy lending measures, then the dollar dropped more. They're thinking that the dollar could drop as much as 15%, according to Jeffries. But don't stick a fork in the dollar just yet. It's not just dead. Now, I talk about it dying a lot, but don't consider it out just yet. Now, the US and the dollar have been having a very rough time, as I said, down huge numbers, the biggest since 2010. But the dollar is still the best house in a bad neighborhood. So as you can see from the chart up on the screen, the US dollar has actually performed pretty well when you compare it against a trade-weighted basket of other major currencies over the past 15 years. So as you can see, the US dollar has appreciated roughly about 18% versus other major currencies. Now, during the March meltdown, the huge demand for liquidity of US dollars was so big, it was so great that it drove the value of the dollar up against all the major currencies into record territory. So this caused the dollar to get really, really strong again. And then what happened? Well, the Fed had to jump into action. They don't want a strong dollar. So they had to jump into action. They had to print more dollars, doing everything they could to normalize things, get the dollar to weaken, get it to come back down to earth. Now, like I said, it's still up about 18% when compared against most major currencies over the last 5 years. And when you see this, even for a dollar bear like me, even for someone who's been predicting the death of the dollar for a long time, it's pretty hard to argue that the US dollar is collapsing right in front of us. Now, if you want to see charts of currencies collapsing, let me show you a couple of charts. Look at the chart up on the screen right now. This is a list of emerging market currencies against the dollar. As you can see, the Brazilian real, the Mexican peso, the Turkish lira, South African rand are all down, ranging from 41% for the peso to 78% for the lira. And if you think I'm just showing you the emerging markets because they're maybe smaller and they're worse off, you can see the chart that I have up on the screen now, which is the same 10-year time frame, but it's for developed nations. So when you're comparing the dollar to other currencies, as in these charts right here, it could be hard to argue that the dollar is on the brink of disaster. And a core reason for the weakness in virtually every other nation's currency is that it holds a trade deficit with the United States. So what this means is that countries sell more goods to the United States than they purchase from the United States. And this creates a deficit, right? It's more, the deficit. And basically what happens is that starts to snowball annually. Now, it's pretty much widely known, most people know that countries like China use their trade surplus to their advantage. So they purchase treasuries, or US dollars basically, to boost up their reserves, which cause the US dollar to appreciate and get stronger and stronger. When they do that, it weakens their own domestic currency, which we just saw on those charts, right? All those currencies are going down. But at the same time, it improves their export competitiveness. So that's why these countries want to have a weaker currency, because they become more competitive on their exports. Now, ironically, a trade deficit between two nations other than the US can still cause the US dollar to appreciate. The reason why is because the country that runs a trade surplus is most likely buying US treasuries with its excess holding. Supply and demand. They're taking those holdings, buying dollars, pushing the value up, which causes the US deficit to increase. Now, even though the US isn't even part of the trade of those two countries, they still get the benefit. And I guess that's the benefit of being the world's reserve currency. Now, we have about 44% of payments over the SWIFT banking network. The SWIFT banking network is what connects, that's the payment system for the entire world. And about 44% of all payments are done through the SWIFT banking network, and they're all done in US dollars. About 61% of global foreign exchange reserves are also in US dollars. It's the reserve currency. Now, there's not another single currency that even comes close to this, okay? So if all this is occurring, then what's driving the US dollar lower? What's it going lower against? Well, a big reason is because of the negative real rate of return you would earn from holding US government notes and bonds. So the rate is positive still, right? We haven't seen the US rate dip into negative territory like we've seen all across the world, but the real rate accounts for inflation. And when you factor that in, you're negative. You're actually losing money when you're holding on to the US government debt, treasuries, bonds, things like that. So for example, right now the US five-year note yields 0.264%. Pretty much zero, 0.264, right? So if you take that rate and then you subtract the US inflation, basically you're left with a negative rate. In fact, right now, every US yield has a negative real return, as you can see from the chart that's up on the screen right now. So look, of course, nobody wants a negative return, right? I mean, if I loan out money, I expect my money back plus a return. I don't want to be paying to loan out money. So investors sell their dollars for other assets, right? At least they're not guaranteed to lose money that way. Like, why hold dollars when I'm guaranteed to lose money when I could hold another asset and potentially have it go up? So these falling US rates and the US dollar is part of the big reason why we see the price of gold rising higher, as well as other types of assets. Now, you can see this relationship between the real rates of returns and gold price from this chart on the screen right now. And it shows pretty clearly that real interest rates go down and gold price goes up. Now, since March 24th, when the Fed basically said they would print to infinity, do whatever it takes, and on and on and on, both nominal and real yields have just been going down and down and down. Now, on top of that, we're seeing dollars being flooded into the system, injected as fast as they possibly can, and that pushes bond prices up, which then brings the yield prices down even more. Now, all this becomes sort of a self-fulfilling prophecy, so to speak. It's like a downward spiral because the worse it gets, the response that they need to take makes it even worse, which then just makes it worse again, which makes the response even worse again, and it's a downward spiral. Now, in the US, as I mentioned in my previous video, which I'm gonna link right up here, I talked about how the Republicans and the Democrats are fighting over whether they should give out another $1 trillion or $3 trillion, all right? Either way, it's trillions of dollars. It's a lot of money, and this is on top of like already $2, $3, $4 trillion that they've already injected into the system. But this is the important piece to know right here. It's not just the US dollar. All the currencies of the world are basically racing to the bottom, all right? It's not just the Fed that's printing all the money right here. The ECB, the European Central Bank, they're injecting another almost $1 trillion, about $877 million, bringing its total pandemic response to about $1.58 trillion. Plus, they have an additional $500 billion from national level stimulus packages. So it really brings the total EU response to $2.1 trillion. Now, that's a huge number. We hear these numbers thrown around so much that maybe we lose perspective of what they are, but they're massive. These numbers are mind-boggling. But not to be outdone, Japan's trying to one-up the EU, and they say, oh, we see your 2.1, we're going to raise you. Japan has dropped 2.2 trillion in the stimulus relief. Now, while these numbers don't seem that far off, well, the US Fed's going to be 2 trillion, ECU 2.1, Japan 2.2. Numbers are all about the same, right? But you have to remember, because I say it all the time, everything is relative. So what are those numbers relative to? Well, the stimulus package is relative to the GDP of the country. Now, as you can see from the chart that's on the screen, this compares the United States, China, Japan, the European Union's, and other countries' stimulus packages as a percentage of the 2020 gross domestic product. Now, clearly, the world has a massive debt problem. And at the rate that I'm looking and the lens I'm looking through, it's not going to get any better, at least not anytime soon. The economy's not going to recover fast anyway, if ever, which means that the debt's only going to continue to grow. So the takeaway here is that it's going to be a continued race to the bottom. Countries around the world are going to continue to keep interest rates low. They're going to continue to jack up fiscal stimulus, and they're going to continue to try to spur economic activity through printing more money, keeping rates low or negative. Now, as they continue to devalue their currencies, it just becomes more and more important that we need to hold our assets, store our value, hold our wealth outside of the government-controlled assets like fiat currency. They are not a place to store your wealth, to store your value. I mean, I guess unless you want to see it go down, but nobody wants to see that, right? So if we want to protect our assets, we need to do it through diversification. We need to get out of the fiat currencies, and we need to get into different types of real hard assets. This is why gold is shooting higher, like I said, crushing new all-time highs, breaking through resistant barriers, and it's why it's maybe one of the best performing asset classes this year. And as you can see from all the charts and data I've shown you, it should continue this way, at least for the better part of the decade to come. Gold, other hard assets, commodities, things that are real, they should continue to do very well. As we print more and more fake money, the demand is going to be for more real things that are limited. So, I mean, I could see gold getting to $4,000 an ounce pretty easy from here in this environment. That's 100% gain just from here. Gold miner stocks are going to do exponentially better. I mean, easily doing 3x, 5x, even 10x better than the gold. So in the next video, I'm going to dig more into gold miners, how they work, what you should be looking for, how you can value them, things like that. I'm going to show you some charts, show you how gold miners stack up to physical gold, and most importantly, like I said, how to find them, how to find the right companies. So stay tuned for that next Tuesday. Now, what I'd like for you to do is leave me a comment and let me know, do you see the trade of the decade lining up just like me? Does the data, the money printing, the debt accumulation, does that make you think that hard assets like gold and Bitcoin and other commodities are going to go up in value? Give me a yes or no. Leave me a comment down below. Let me know. Leave me a thumbs up on this video if you like it. If you don't like the video, that's okay. Give me a thumbs down. Either way, I always want to hear from you. Leave me a comment, yes or no. Are commodities going to go up? Is it going to be the trade of the decade or not? And that's all I got for you on this video. To your success, I'm out.